Howdy, everybody. So we're going to jump into the lease chapter now. And this is chapter 15. We already covered chapter 14 in intermediate one, so we get a pass on that. Leases and leases and lessees and lessors is a very detailed subject. So you're going to want to stay up on it. You're going to want to work a lot of problems so that you get used to the setup, the components of every problem. The problem with leases is that the details in leases tend to give rise to various accounting treatments, depreciating over the lease term or the entire useful life of the leased asset, sales type versus direct financing leases. And so there's lots of different ways that things can fall out given the nature of the contract. Also be aware that the rules for leases are changing, and I'll have some general comments on that as well. The changed rule for leases goes into effect, I believe, after December 31st of 2017. So there's going to be a little bit of a different outlook. Not too much changes. They had some more radical ideas in mind, but then backed off of them at the last minute, as is typical. So what is a lease? A lease is a contract between two parties, the lessor and the lessee. So the lessor leases the asset to the lessee, who then is using it and pays rents back to the lessor. And so if you want to think of it in terms of renter, this is the renter over here, and this is the landlord, so to speak, or the leaseholder, the person who leases the item, the lessor. Legal title will typically remain with the lessor, even though the lessee, the renter, will have possession of the leased asset. Whether or not the lessee will record the lease on the books as an asset is something that we have to deal with through the accounting for leases. There will be different executory costs, and they can be assumed by either party. It's considered an executory contract because it is a contract that is under terms that neither side has completed. The lessee has not paid all of the costs, and the lessor has not provided the use of the asset for the entire time. These costs that can come in are maintenance, property taxes, insurance. We'll talk about the treatment of those costs a little bit later on. So who are the lessee and the lessor? The lessee is the party that is renting and paying. The lessor is the party that's collecting payments and giving up the asset to the lessee. So are all leases the same? And definitely not. You're going to see that there are many different types of leases, and the substance of the contract will give rise to different treatments as we look through the chapter. Typically, we're either going to treat it in substance as a purchase or a rental. So a lease is a purchase. This is the capitalized or the capital lease treatment. We capitalize the lease on the lessee's books if most of the rights and risks of ownership are transferred. If that's the case, then the lessee will record an asset and a liability on its books. If it's a rental, then the lessor retains the primary rights of ownership, and the lease will just be accounted for as a rental of property. In that case, then the lessee does not record the asset or the liability. This is typically called operating lease. So which one would they rather have? All things being equal, by classifying the lease as a rental, the lessee does not have to have a lease liability on the books, so they get that off the balance sheet financing. Any sort of rental is going to produce, anything that is classified as a rental will produce lower expenses during the early years of the lease term. So those lower expenses during the early year will bring about a higher income than we would have otherwise had. If there is a bias, then the bias is always to treat something as an operating lease, mostly because of the liability aspect and having off the balance sheet financing. That's one of the primary reasons you want a lease, that you don't have to record a loan payment, and also the whole income incentive. If we want to err, in accounting, we want to be more conservative. So we try to make the rules such that most leases would be classified as a capital lease, but it's still, there's workarounds, right? Management knows the numbers that are required, and so they can do everything in their power to make sure they get what they want. What is the advantage of leasing from the lessee's perspective? The lease payments are fixed. If something becomes obsolescent, then if it's out of date, we can just lease a new item. We don't have an ownership, right? We can just end the lease or terminate it after the lease term is over. Leases contain less stringent covenants than some loans may require, because if you're going to finance, right, then you're going to have a note payable of some sort. So you're going to have some sort of a loan, which would mean that you would have financing costs. In a lease transaction, you have collateral in the exchange, obviously, because you have the leased asset itself, and the loan provisions on a lease are not as taxing as the other sort of loans that you could take out to purchase a fixed asset of some sort. And then leases may not be adding to the existing debt on the balance sheet. That is the operating lease advantage. If you have a capital lease, then that's not an advantage. And then there's tax deductible payments of interest that we record when we have a lease. And so that's also beneficial, although that's beneficial with any debt. So, that doesn't give it an edge over debt. It's just one of the advantages of leasing. So when substantially all of the rights of ownership are transferred to the lessee, we will record it as a capital lease. We believe that this contract in substance is a purchase. Therefore, we record, or as the lessee, we record the present value of minimum lease payments, that's the asset, and the lease liability is the present minimum value of lease payments. So, what we're doing then is just having a leased asset and a lease liability for the same amount. And then over time, if we record this as a capital lease, then we want to apply depreciation expense. Since we have a leased asset on our balance sheet, we would have interest expense when the carrying value of the liability times the rate of borrowing. So the carrying value of the liability would be that lease liability that I was mentioning. And then we'll talk about what rate it could be. It could be one of two rates, depending on the contract. But that is very similar to the effective interest rate method that we've seen before in borrowing for bonds and notes. And then, of course, also the executory costs of the lease if they are on the lessee's side. So that's not necessarily the lessee's responsibility, but it could be. If it's regarded as a rental agreement, not a purchase, then it's an operating lease. Then nothing goes to the balance sheet. We don't have any balance sheet effects, no lease liability, no leased asset. And we will have some prepaid rent because lease payments are typically made at the beginning of the period. And we will pay our rent at the beginning of the year. That establishes a prepaid rent account. And as we make cash payments, we would have rent expense over the period as we adjust for those big payments. So how do we decide this? There are 4 criterion. Any one of these criterion being triggered makes this a capital lease. So we only need one of 4 in order for this thing to be classified as a capital lease. Like I said, we would rather treat a lease as capital than as operating, knowing the incentives of management to have an operating lease. So if the lease transfers ownership of the asset to the lessee by the end of the lease term, if there's just a transfer title, then obviously it's a purchase, right? That one's pretty clear. If it contains a bargain purchase option, a bargain purchase option, as we'll talk about down here, is just an offer for the lessee to buy the lease at the end of the lease term, buy the leased asset at the end of the lease term for a bargain price, hence the name. Then we have the useful life rule, the 75% life rule. If the lease term is greater than or equal to 75% of the economic life of the leased asset, economic life also could just be used as useful life, how long the leased asset would be of use in general. Then we say that they have purchased it because they're using it for substantially all of its life. And then if the present value of minimum lease payments are greater than or equal to 90% of the leased assets, that should be an apostrophe, fair market value, then again, we've decided we've purchased it. So we've paid basically the market value of the leased asset with the rental payments we're making. Hence, it is ours, a purchase. What are the MLPs, you may ask, now that they've got brought up? Well, in a lease contract, it's everything that the lessee is responsible for except executory costs. So those are backed out. We have rental payments. Those are going to occur on a monthly or yearly basis. Bargain purchase options. Again, we assume that the option will be used because it's a bargain option, therefore we count it. A guaranteed residual value. That's when the lessee signs an agreement that says they will return the leased asset with a certain amount of value remaining on it. They won't ride it into the ground, right? They won't ruin it and then bring it back to the lessor. And if there's any penalty that's required for a failure to extend or renew the lease. So any costs that would be triggered by the lessee, except those executory costs. Even if the lessee is responsible for them, they don't go into MLPs. In the PV calculation, those rental payments are my PMT, and the BPO and the GRV are my FVs. So this is my PMT. These are potential future values. There will only be one or the other. There's not going to be both, so you don't have to worry about taking both. Like I said, the bargain purchase option is just a bargain at the end of the lease term to purchase the item that you've been renting. The residual values that I'm talking about, the guaranteed residual value, the unguaranteed residual value, these are just, as we saw in depreciation, estimates of the fair market value that the leased asset will have at the end of the lease term. If it's a guaranteed residual value, that affects the lessee, because the lessee is then saying, all right, well, if it comes in under that value, I will give you some cash to compensate. So now this becomes a cash flow that the lessee is responsible for, since it is a guarantee of value, and therefore we include the GRV in the payments. Now, this is an interesting case of a UGRV where it does not affect the lessee because it's unguaranteed. It is a residual value set by the lessor when they are deciding how much they want to charge per rental payment. If you think about it, right, they have to consider, well, how much are we going to get every period for rent? Then when we get the leased asset back, how much does that provide in terms of a return? If I'm getting back, a car that would still be worth $20,000 at the end of a lease term, that certainly is part of the return I'm getting on the entire deal. So the UGRV is a big deal to the lessor because they're figuring out how much they want to charge you as the lessee, but the lessee is not responsible for the cash flow, hence it's not in their MLP calculation. So with regard to the rate to use, what do I want to use in my PV? There's two that you could use. There's the lessee's incremental borrowing rate. So this is what the lessee would have to pay on any other contract, right? This is essentially the market rate of the lessee. The lessor is going to set an implicit rate of return. This is their return on the lease deal. It's not always going to be known by the lessee. So they might set a rate of return by, charging $100,000 per month for 3 years, plus the fact that they're going to get back a leased asset at the end of that 10 years with a value of $10,000. They're going to set a rate of return, and then that will set their payments. They'll say, I want to earn 6% on this deal, or I want to earn 8% on this deal. right? So that's how the lessor sets the payment. We'll talk a little bit more about that when we get to the lessor side of things. But right now, just understand that the lessor's implicit rate of return is what's going to equate all the cash flows in the lease, right? So it is the rate of return that the lessor will earn. So which one do you want to use? You're going to want to use the lower of the two. Why are we using the lower of the two? Remember that we're trying to classify things as capital, trying to classify as capital. And if there's a change in rates, the I is going to affect the MLPs. If I increases, that means that all things equal, right? If we increase our I, what happens to a present value? If we increase our I, that typically means present value is going to fall, versus when we reduce our I, that means that the present value will rise. So if we're under this case, we want to take the lower of two interest rates, we're having a lesser interest rate, we're having a greater present value, it is more likely that I'm going to say yes to the MLPs being greater than or equal to 90% of the fair market value of the leased asset. Like I said, it's not particularly common for the lessee to be able to calculate the lessor's implicit rate of return. And so a lot of times we'll just use the incremental borrowing rate. But if you know both, if the lessee knows both, they need to use the lesser of the two of those. Lease valuations. Remember, an operating lease has no valuation because it doesn't need to be recorded on the balance sheet. For a capital lease, it's the present value of the minimum lease payments. So we're looking for a present value, the future value being a BPO or a GRV. The PMT are the rental payments, excluding executory costs. Sometimes those will be wrapped into the rental payments, so we need to back those out prior to capitalizing and finding what the present value is. The I is the lower of the incremental or the implicit rate, and the N is going to be the term of the lease, not the term, not the useful life of the asset, but just how long the lease agreement is going on for. Operating leases are going to have few effects on the financial statements. Like I said, that's why they are preferred. There will be some prepaid rent, there'll be some rental expense, and that's it. No asset is recorded, no liability, no interest expense, no depreciation expense. So a lot of those expenses go out the window. With a capital lease, we have to think about depreciation. And when we depreciate the asset, we have to understand why we decided to record an asset. So if the lessee qualifies the lease as capital because of rule number 1 or number 2, that's the transfer of ownership or the BPO, we should use the useful life of the leased asset. The idea here is that if we are going to buy it because of the bargain purchase, we assume we're going to buy it, or because transfer of ownership is going to occur, we're going to have this lease for the entire life of it. If it got capitalized because of rule number 3 or rule number 4, that is the useful life rule, where it's greater than or equal to 75%, or greater than or equal to 90% of the fair market value of the leased asset. The MLPs are greater than or equal to 90% of the fair market value. Well, these do not necessarily indicate that we're going to own the leased asset at the end or after the end of the lease term. We're going to probably return it, even if we used it for, say, 80% of the useful life. We still haven't used it for the entirety of the useful life. And so rather than use the useful life of the leased asset, we use the lease term in order to figure out how long we should actually use the asset. And we want to use the lease term. And in the case of 1 or 2, we used salvage value, like what is the ultimate value when this thing is done at the end of its useful life, versus the guaranteed residual value, which is what is the value of it at the end of the lease term. So our thinking transfers from the end of the asset's life period when we're in rule number 1 or 2 to what is going to be going on at the end of the lease term if we violate or if we capitalize because of rule number 3 or 4. Interest expense is going to be recognized, as always, as the rate used in valuing the lease, as either incremental or implicit, and multiplied by the last carrying value for the liability. So that lease liability is going to be multiplied by whichever one we use, the incremental or the implicit, and that will provide my interest expense. So, and remember, this is very, very similar to how we dealt with interest expense and interest revenue in any time value of money situation. So it's like, remember again, the one of two of those rates. And finally, the executory costs. I'm sorry, I did see that was off the page. And finally, any of the executory costs that we have, maintenance, insurance, taxes, these are either going to be a duty of the lessee to discharge or a duty of the lessor to discharge. Sometimes the payments are due directly to the third parties, the taxing agency, the insurance company, anything like that. Well, then that's just a period cost, not capitalized. If they're included as costs in the rental payments that the lessor is charging, again, remember, we need to back those costs out before we calculate the MLP, because otherwise we're going to capitalize some of the cost of these insurance and taxes when that's not part of GAAP. Okay, we will do the examples in class. Lease accounting is very step-by-step. We'll work through the example 1, example 2, and then I'll give you guys another problem to work out and kind of figure out on your own. All right, see you soon.